Hello and welcome back to StockSynops. I'm your host, bringing you bite-sized lessons on the world of investing. In just 5 minutes, we'll break down key concepts to help you build your financial knowledge quickly and confidently. If you're catching up, check out our earlier videos. The basics of investing, stocks, bonds, markets, and how buying and selling works. They're the perfect lead-in. Today we're tackling something crucial: risk and reward, the fundamentals every investor needs to understand. Let's jump right in. Investing is all about balance. Higher potential reward usually comes with higher risk. Risk means the chance your investment could lose value, at least in the short term. Reward is the potential gain, like price appreciation, dividends, or interest payments. The key? No free lunch. Safe investments offer low rewards, while high-reward ones can be bumpy. Let's look at the main types of risk beginners face. First, market risk or volatility. This is the up and down price swings we talked about last video. Stocks can drop 20%, 30%, or more in a bad year, like during recessions or market crashes. Bonds are steadier, but even they can fall if interest rates rise. Then there's inflation risk. If your returns don't beat inflation, your purchasing power shrinks. Right now, inflation is around 2.7% annually, so you need at least that much growth just to stay even. Other risks include company-specific risk, if you own one stock and the business struggles, or interest rate risk for bonds. How do we measure reward? Historical averages give a guide. Over long periods, the stock market, like the S&P 500, has returned about 10% annually, including dividends, or roughly 7% after adjusting for inflation. That's way better than savings accounts, but with big swings along the way. Bonds, safer, often 4 to 6%, closer to inflation beating but lower growth. The golden rule: the more risk you take, the higher potential reward, but also higher chance of losses. Your risk tolerance matters most. Ask yourself, how would you feel if your investment dropped 20% in a year? If that keeps you up at night, lean toward bonds, funds, or balanced mixes. If you have a long time horizon, like 20 or 30 years to retirement, you can handle more stock volatility, because markets historically recover and trend up over decades. Time is your friend against risk. Short-term, markets are unpredictable, like gambling. Long-term, patience turns risk into reward through compounding, which we'll explore soon. Diversification helps too, spreading investments to reduce the impact of any one bad performer. We'll cover that next video. Simple ways to think about your risk level. Conservative, focus on bonds, stable funds, preserve capital. Moderate, mix of stocks and bonds. Balanced growth with some protection. Aggressive, heavy on stocks or growth funds, aim for higher returns, accept bigger dips. No one size fits all, so it depends on your age, goals, and comfort. To wrap up today, risk and reward go hand in hand. Higher potential gains mean more ups and downs. Understand your tolerance, match investments to your timeline, and remember, the market rewards those who stay invested through volatility, not those who chase hot tips. Please remember, this video is for educational purposes only and does not constitute financial advice. Investing involves risks, including the potential loss of principal. Always do your own research, or consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. If this helped you grasp risk versus reward, give it a like. Subscribe for the full beginner series. And comment, what's your risk comfort level? Conservative, moderate, or aggressive? See you next time when we talk diversification, spreading your eggs across baskets. Thanks for watching StockSynops.